Hello again. Welcome back to GPA Factory. In this video, we're talking about external funds needed. External funds needed, EFN. So funds needed or external funding needed is really us taking a look at our income statement and balance sheet, and then we are forecasting for next year, and then ultimately trying to get down to a new total assets estimate and a new liabilities and equity estimate to then compare the two to decide how much additional funding we might need. So a lot of times we're going to end up doing this income statement. We're going to add some stuff to retained earnings, and then we are going to, calculate our balance sheet, and then we're going to have an imbalanced balance sheet. Our assets are not going to equal our liabilities and equity because there's going to be some things that do not necessarily increase proportionally with sales. Like most of these items, we're going to make an assumption do increase proportionally with sales, but there's going to be stuff like common stock or long-term debt that are not going to increase proportionally with sales. And that's going to throw off our assets equal liabilities and equity number a little bit to calculate our EFN. But it really is just being methodical. I don't think that this is really too hard. It's not like conceptually dense. It's just a lot of like random small math things that you need to make sure that you're not making any like minor mistakes. But it's going to be something like we're given, that in the question, we're given that sales are going to increase by 20%. So then we're going to say, okay, well, that means that sales are going to be 120 for the year. And then we're going to make some assumptions about what happens to everything else, that everything else is really going to stay the same percentage of sales. So all of those things are going to increase by 20% as well. So we're going to basically create a new income statement based on that in everything else increasing by 20%. Then usually we're given some assumption about retained earnings and whether those stay the same or what amount is being paid out as dividends to help us know what net income is actually going to be added to retained earnings. So we're going to go ahead and do that as well. But again, it's just working through our income statement and balance sheet until we get down to our assets and liabilities and equity number to then compare. Okay, for EFN questions, we're typically told what percentage sales is expected to increase by, which then allows us to estimate a lot of different things. So it's going to allow us to estimate all of our income statement items. So assuming that everything stays the same percentage of sales. So like if sales increase by 20%, we could just multiply by 1.2. And we can then multiply everything else by 1.2 as well, because everything stays that same percentage of sales. And then all of the balance sheet items, we're going to assume that all assets, unless we are specifically told otherwise, sometimes, very, very occasionally, we'll have fixed assets that aren't necessarily going to increase proportionally with sales. But assuming that all assets and current liabilities are going to stay the same percentage of sales, that means that we can just multiply all of those by 1.2 as well, if it is that sales increase by 20%. Then retained earnings, that's going to trickle from the income statement and our knowledge of the retention rate or dividend payout rate. Both of those are telling us the same thing. And then long-term debt and common stock will stay the same for now. So when we go through, we're going to keep those the same. And then ultimately, the external funds needed. The external funds that are needed is going to be total assets minus total liabilities and equity. So if our forecasted assets are greater than liabilities and equity, that means that we need additional sources of funding to reach that level of assets. So we'd have to go out and issue new shares of stock, or we'd have to go out and borrow more money from bondholders or from the bank in the form of notes payable. If our forecasted assets are actually less than liabilities and equity, a little bit of a weird scenario, but that means that we could actually retire some debt or repurchase stock or pay out additional dividends so we could use up some of that additional excess sources of funding in some way. Okay, so it'd actually be external funds like not needed, or if it's negative, it's non-funding needed or something like that. So that's like conceptually what's going on there. But again, mathematically, we're just trying to get down to a forecasted balance sheet where we've got total assets and then total liabilities and equity to then compare the two to figure out what is the additional amounts that we need. And here is going to be that process. So using our income statement that we were previously given, let's create a forecast assuming sales are expected to increase by 20%. So this is really how easy this is. Let's kind of move this around. So next year, so we'll say for 2028, we're literally just taking all of these numbers on the income statement and multiplying it by 1.2. So here, 100 times 1.2 would be 120 as our sales. And then everything else trickles down from that. So the other way to do this, and this is why sometimes it'll, it's suggested that you will create a common size income statement so that you know that this is 40%, this is 60%, because then, and then this is 10% and 2% and 48%, yada yada yada, all the way down. Because then you can just take 40% of the 120, and that's this number, 60% of the 120, and that's this number. But I think that that's actually doing more work than you need, because you need to create these percentages first, and then you're going to multiply the 120 by the 40. So it's just like you're doing two math steps there for each one of the line items, rather than we can just take 40, multiply it by 1.2, and we get that that's 48. Okay. And that's the exact same thing as us taking this 40% value, so 0.4, and then multiplying it by the 120. So I'm just saving a little bit of time there. We also get that 48. So I'm just saving a little bit of time and saying, if we know that all of our items are going to increase proportionally with sales, then we can just multiply each one of them by 1.2. So here we've got 60 times 1.2, and we got 72. We could have just subtracted there as well. Here, 10 times 1.2 is going to be 12. 2 times 1.2, and we get 2.4. And then 48 times 1.2, we get 57.6. 8 times 1.2, and we got 9.6. 40 times 1.2, and we got 48. 16 times 1.2 is 19.2. And then 24 times 1.2 is 28.8. And that's in millions. But there we go. That is our net income number. I'll just slide that up here for a second. So $28.8 million is net income. And typically, which we will see, I think, on the next page, hopefully I gave this to you, it tells us retained earnings. And it tells us, yeah, at the end of 2026, it tells us what retained earnings are, so we know what was added to retained earnings. Okay, so we have enough information. We'll actually use this on the next page, but we're gonna have to figure out, given information about what happened previously, we're gonna have to figure out what is the amount of this 28.8 million that gets paid out as dividends versus gets added to retained earnings. Okay. So now, using the balance sheet previously given, create a forecast assuming sales are expected to increase 20%. And we do make the assumption that all of our assets increase proportionally with sales. So we're going to say that those all increase by 20%. All of our current liabilities are going to increase 20%. Long-term debt, we keep the same for right now. Common stock, we keep the same for right now. And then the amount that gets added to retained earnings is going to come from income statement in terms of our net income, and us keeping our retention ratio the same. So here we have this information. It says the retained earnings at the end of 2026 was 132 million. So at the end of 2026 was 132. We know at the end of 2027 was 150. And so we have some addition to retained earnings here of 18 million. Okay, addition to retained earnings of 18 million. So what we can look at is ending retained earnings. So a couple of ways that we can think about this. The ending retained earnings is the beginning retained earnings plus what makes it go up, net income, minus what makes it go down, dividends. Well, we know that the total addition is this 18 million. But the other thing that we know is that for 2027, right, our net income was 24 million. So really our net income of 24 million, right, means that we can calculate what our dividends are if the overall was an increase of 18 million. So we know that, I'm just subtracting 132 from each side. We got 18 equals 24 minus our dividends that were paid out. That means that the dividends paid out were 6 million. So that helps us calculate our dividend payout ratio and retention ratio. So of our last year's 24 million of net income, 6 million got paid out as dividends, and 18 million got added to retained earnings. So that means that our retention ratio, 18 out of the 24, is 75%. And that is what we assume is going to stay the same. Sometimes it will just tell us what that retention ratio is. Other times, I actually did this one, I think, in a little bit of a harder way, where we have to calculate what amount actually got added to retained earnings and take that as a percentage of that net income. So we have to calculate what that retention ratio is. So be careful there. Okay, so we have that retention ratio of 75% that we are going to end up using with this 28.8 million. So let's just go ahead and knock that out. But the 28.8 million times 0.75, and we got that 21.6 million gets added to retained earnings, whereas 28.8 times 0.25, 7.2 million gets paid out as dividends. All right, so here is how we are going to create this new balance sheet. And again, it's going to be that these numbers are going to increase proportionally with sales. So just like on our income statement, we can take 200 times 1.2. So we've got 240. 160 times 1.2, we get 192. 50 times 1.2 is 60. 400 times 1.2 is 480. 60 times 1.2 is 72, which is going to be subtracted. So then our total assets, 240 plus 192 plus 60 plus 480 minus 72 is 900. Okay, so we have 900 as our total assets. Total liabilities, we're going to do very similarly for our accounts payable, notes payable, and accruals. So we'd have 50 times 1.2 is 60. 190 times 1.2 is 228. And then 40 times 1.2 is 48. So that we get total current liabilities of 60 plus 228 plus 48. And so hopefully this is starting to make sense that this isn't like too difficult. Like the conceptual understanding here is like not bad, but we just have to be careful that we're not making any simple mistakes. Now, long-term debt, that is not typically going to increase proportionally with sales, but that would be something that once we calculate external funds needed, then we would increase our long-term debt. Or once we calculate external funds needed, then we would increase common stock. So here we have that's 20, and then we've got 356 is our total liabilities. And then same thing with common stock. Common stock isn't typically just going to go up spontaneously. They're not just going to increase along with sales, but that would be something where we have to go out and issue new shares. But then retained earnings. Remember, we said that retained earnings, we added 21.6 million from our net income. So that's going to be the amount that comes from that income statement. That's the whole reason that we had to do our income statement, is to get down to how much gets added to retained earnings here. So that's going to be that 150 plus 21.6 is 171.6. So we've got total equity of 471.6. But then we have total liabilities and equity, 356 plus 471.6 is 827.6 million. And so it's asking, what is the EFN? So we've just gone through and we've created this income statement and balance sheet, and we see that our assets, 900 minus the 827.6, is going to be our additional or external funds needed, minus 827.6, and we get $72.4 million. So that means that we need to go out and we need to issue more debt, or maybe issue more shares of common stock for this company. Okay. Okay, if the fixed assets were only being operated at 90%, how does this change things? So the fixed assets being operated at 90%, here's effectively what we're going to do. We're going to take our net fixed assets, which in this case is the original amount of 400 minus 60. That's 340. And we're saying that we're only operating them at 90% of capacity. So that means that how much we're actually utilizing, we're not utilizing 100% of our fixed assets, we're only utilizing 90%. Well, how much we're actually using is going to want to increase proportionally with sales. So we would say that 340 times the 0.9 is 306. That is going to want to increase proportionally with sales. That's going to want to increase to 367.2. 367.2. So if we originally had net fixed assets of 340, that's going to want to increase up to 367.2, not up to what we calculated before. 480 minus the 72 is 408. It's not going to need to go up all the way to 408. We can actually increase it to less than that, which is going to end up reducing our EFN. So that would just lower the amount that our net fixed assets, which is these two numbers combined, it's going to lower what that net fixed assets total is, but then you're just going to add up the same way. You would just get a little bit lower of an assets number here, and then the lower assets number, you would subtract off your liabilities and equity still to get what that external funds needed number is. Okay, we're going to calculate both the IGR and the SGR. So IGR is the ROA times the retention ratio divided by 1 minus ROA times the retention ratio. Okay, so ROA is going to be net income divided by total assets. Okay, net income divided by total assets. So let's just go ahead and do that based on the original information that we were given. So the original information that is given is net income is 24 million as a percentage of total assets, which is the 750, times that retention ratio we calculated was 75%. And then we're going to do that 1 minus that same amount. Okay, so let me go ahead and calculate what that value is. So 24 divided by 750 times 0.75, you get 0.024. So 0.024 divided by 1 minus 0.024, we get 2.46%. So that's what our growth rate we could sustain if we just wanted to fully fund this growth through only retained earnings. That is the growth rate that could sustain that. Anything else, anything above 2.46, and we're going to have to go to issuing new debt, or we're going to have to go to, issuing more shares of stock or some other, external source. Okay, the sustainable growth rate. Sustainable growth rate is the same thing, except we're doing ROE instead. So sustainable growth rate is going to be the ROE, which is the 24 of net income divided by total equity, which is the 450, times, again, the retention ratio divided by 1 minus, and it's going to be that same thing. And that is going to be our sustainable growth rate. So 24 divided by 450 was 5.333 times 0.75. We get 4% divided by 1 minus 4%. And we get 4.17%. So this is the amount of growth that we could sustain from both retained earnings, right, and long-term debt. So by avoiding having to issue new shares of stock. So there we go. Those are going to be the two, the internal growth rate and the sustainable growth rate figures based on the information that's given. And again, with this, it's just going to be a lot about practice. You're going to want to make sure that you're getting in some practice for filling out what that new income statement number looks like, or what that new income statement looks like, and filling out what that new balance sheet looks like to figure out what your external funds needed are. So hopefully that makes sense. If you have any questions, you can ask on the question wall. You can also email me at chris@gpafactory.com. Take it easy, everybody, and we'll see you in the next video. Thanks for watching that GPA Factory video. Hopefully that was extremely helpful. If you found it to be helpful or to kind of clarify some of that content, You can also have access to a free month of membership if you follow this link and use the code YouTube100. Now, with the GPA Factory membership, you'll have access to weekly review sessions that are 1 to 2 hours posted every single week that come with practice questions to help you along with your studies and have video solutions to those. In addition, it'll include an exam review as we get closer to the exam that'll have even more practice questions and video solutions to those given out as well. You also have 24/7 access to our question wall if you get stuck while you're studying, and you get discounts on private tutoring. So if all of that sounds great, again, go to this link and use the code YouTube100 to learn from one of the best to ever teach this course. That's me. So try it out, see if you like it, and yeah, we'll see you around. Thanks.